2023 has been a very good year for the stock market, certainly relative to what we saw in 2022. But with this slide, I want to make a point that the growth that we've seen on a year-to-date basis, actually this slide goes to the end of June, is attributable primarily to 7 names in the S&P 500. 70% of the return in the S&P 500 is attributed to NVIDIA, Meta, Tesla, Amazon, Apple, Microsoft, and Alphabet. And the other 30% of the return is attributed to the other 493 names in the S&P 500. So whereas the S&P 500 is up 17% on a year-to-date basis, if you were a stock picker and you were focused on small cap or value or non-tech names, you have likely significantly underperformed the S&P 500 on a year-to-date basis. The important thing to note is, yes, these names are potentially still have opportunity, and we remain diversified in other areas. The important thing to note in our mind is that this is not a tech bubble. Just because these names are very heavily tech focused and we've seen their values climb early this year on essentially the hype and the growth of artificial intelligence, and in the case of Tesla, AI, self-driving, a lot of other different tech drivers. The thing to note here is that back in 2000, when we were getting the peak of the tech bubble, PE ratios across the board were approaching 59. That is PE ratio being the price of the shares versus those shares' earnings. Today, we're at about 28. So again, roughly half of where we were from a PE ratio standpoint. So whereas in 2000, prices got extremely elevated, PE ratios came down, prices came tumbling, we're not seeing that today. PE ratios, despite the recent growth, still make sense, and we're still very confident in the stock market from a fundamental position. So again, if you have questions about this or anything else, just let us know. We'll be happy to talk. Thanks. Have a great day.